Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for November 23rd, 2020. Please see our disclaimer for important information. Now here's our weekly COVID tracker, plotting the 7-day moving average for daily new positive cases for coronavirus, as well as 7-day moving average for daily deaths. You can see that the daily death figure is beginning to retouch those levels that we saw back in July, and that's on the basis of a fairly pronounced multi-month trend in caseload build, if you will. And this is on a national scale. We continue to see a fairly strong new case numbers coming out of the Midwest as well as the West. And really all areas of the country are now participating in this fairly strong upsurge. But clearly, and you'll see in the next chart, that mortality rates are going down, even though that aggregate number of new 7-day moving average deaths are kind of retouching that July that load factor. But something that obviously we're going to have to consider and see how it plays out is the impact on mobility. Thanksgiving, that we're on the eve of, is traditionally one of the most robust travel weeks of the year, if not the most robust travel week of the year. And obviously a lot of the numbers are expected to be down. A lot of trips are being canceled, so on and so forth. Mobility will be down considerably as a result of that, and we'll just have to see what this does on the national psyche as well as on national spending and consumer behavior. But clearly we are continuing to see this continuing trend in positive cases. This is the case fatality rate, which I think is important to watch amidst the headline number, which is the number of new cases. And that number, like we saw in the last slide, is going up at a geometric rate. Alarming though it may be, it's also important to know that that the mortality rate is actually going down. It continues to slide down as new therapies and treatment protocols are being developed to treat the symptoms once they're onset. Obviously, there's a lot of activity going on behind the scenes with regard to vaccine development, but that's on the prevention side. This is, what I'm talking about. It has a lot more to do with once you present with symptoms, how are those symptoms being treated, and that's getting people out in front of this virus a little bit better. Obviously, the main issue here, and we've got a slide on this, is on hospitalizations. So this is from government data that's provided to us at fairly real time. I mean, this is as of the 17th, so this is reporting through all 50 states. And this chart has evolved somewhat. We've been looking at it for about the last 3 to 4 weeks. And you can see that some states that were in that orange factor, or in the orange area, which is below 10%, of the inpatient beds occupied by COVID patients, you can see that there's more of those blue states that are kind of perking into that 10 to 14 or 15% level. And then clearly in the Midwest, where we've seen a spike in cases, like in the Dakotas, we've seen, and frankly, where there are fewer overall inpatient beds available, that we're clearly seeing an increased load there. But this is the main worry with this virus. It's the load factor on our healthcare system, and it was the primary reason back in April that the economy, or frankly in March rather, that the economy was shut down to prevent this kind of overrun on the system. But the issue right now is that back in those early months, there were basically hot pockets of activity where you could concentrate resources and isolate the virus. Now, with the 7-day moving average of new cases, I mean, the onset is fairly widespread all across the country. So there really isn't a way to kind of mobilize resources. So that's obviously a concern for healthcare and elected officials. This is an update to what we've shown you in the past. I think we've shown this multiple times. So there continue to be more therapies entering this pipeline, and there are 38 now in phase 1 testing, and phase 3 is where we begin to really see, kind of the proof in the pudding, if you will. And so we have 12 vaccines that are entering large-scale efficacy tests, which is really good. We have several that have received emergency use authorization, or EUA, and one of those, obviously, very notably, is Regeneron, which is what the president was given when he presented COVID positive. And in addition to that, we've got the Moderna and the Pfizer therapies that are in that basket as well. Here's our high frequency data, and as you might expect, with the rise in cases and the greater share of the headlines given to that we've seen a decrease in hospitality activity, restaurant activity. Ironically, TSA checkpoint data was up slightly for the week, but it's down again for the month. And we just, this is something that we knew that with this rise in cases, that it was just going to take time to see. Now, on the industrial side and commercial side, we continue to see rail car traffic continue to improve, and we continue to see some positive evidence on that front. Jobless claims continue to go down, and continuing claims bouncing around a little bit, but overall in a relatively decent trend. Jobless claims were up slightly last week, but the trend over the last month is definitely favorable. But I think what we're generally speaking, what we're seeing here is that production data on the especially on the manufacturing side is looking a little bit better. Consumer related sentiment indicators are trailing off, and the big question is, what are they going to look like a month from now? So we'll be monitoring. This is a kind of almost a good feel index here. I put this in here for fairly good measure. So there's been a lot of optimism that's invaded the equity markets over the last several weeks related to vaccine therapies. And so what this chart tells you is that just here recently, we've had a profound spike in the probability, at least the expectation, if you will, of having 25 million inoculations in the U.S. By the end of the first quarter. Now, I know that there's a lot of heavy lifting that's going to need to happen between now and then, but a lot of discussions are and a lot of headlines are being made with the amount of doses that can be delivered. A lot of questions still remain with regard to storage, delivery, and how many doses are actually going to be needed per person to inoculate oneself against the coronavirus. But obviously the sentiment has changed, and we're kind of pulling up the expectations from roughly, call it 10, 11 months to more like, within 6 months. So we'll have to see as things develop. I've shown this from Civic Science a couple times, and they've done different kinds of surveys. This is early November, so it's still fairly recent, and so it's real-time data, if you will. So quarter of the population would get the vaccine right away if the FDA approved it, and interestingly enough, you have 15% that are agnostics down on the bottom, and then you actually have 16% of the population that say that they wouldn't get it at all. And then you've got another part of the population, as you can see here, that would wait a while. And I think there's a lot of folks that are buying into this notion that we've never done a vaccine this fast, and there's some unknowns with regard to what the side effects might be, and we're already starting to hear about some of those types of things. But clearly there's some people that would be a little bit more hesitant to take that vaccine for the virus when it's available. Now we get into some of the economic data. Again, I mentioned before that manufacturing is doing well. You can see this. This is a diffusion index. So the Philly Fed manufacturing index and new orders. Those charts look very similar, but they're trending positive. They're kind of holding in there. We had a strong bounce back, and for the most part, we've had some staying power in manufacturing, and that's a really positive sign. Even though manufacturing is less than 15% of the total economy, you like to see that as kind of the backbone of your economic of your GDP rather. Kansas City Fed Manufacturing Index, again, it's just another regional type survey. This too is a diffusion index, so readings over zero indicate expansion. So we're in really good shape here on the Kansas City Fed. Manufacturing, this is something though that I'm watching too, and this relates to kind of employment and the health of the labor market in general. So, while the manufacturing sector has done well, we know that there's increased automation that's being introduced into manufacturing, and so manufacturing employment may not dovetail. And in this case, what this shows is that it is in fact not tracking one-to-one here with the manufacturing index. We've actually seen a pullback in labor and manufacturing. The risk is that we continue to see a pullback or a slowing of growth in labor anyway. So we'll just have to wait and see, monitor this as well. We've got some housing data, which again, the housing market remains exceptionally strong, exceptionally strong. Existing home sales have a very traditional seasonal pattern, but as you can see here on the left, that's clearly not the case in 2020. This is an area that continues to outperform. This is data that it's just hard to imagine because we just don't see it like this. But given that this is an odd year, we should probably expect odd data. And indeed, this is odd, but it's very positive though. And on the right side, you can see the distribution of existing home sales between a single family and then single unit condos and cooperatives. Either way you slice it. And then going back, I included the one on the right because it gives you a trend line dating back to really 2000. So when you think about the excess and the froth that we saw in the residential market in 2006, which began to roll over ahead of that, the financial crisis, we're actually back up to those levels, and this is a unit number in millions. So it's interesting to see that we've kind of retraced that and in fairly short order amidst this pandemic. Single family starts, this is versus the previous cycle. Again, this is kind of taking some of that data that we saw in that last slide and kind of transitioning it over to kind of a different view. But as you can see, the current what we'll call great lockdown and recovery, those numbers are skyrocketing beyond where they were in 2008. And the main takeaway in 2008 was that it actually took a while for us to bottom out, and we've done that much more quickly this time around. And we've covered much more robustly this time around. Some of this has to do with interest rates being low, but they were low back in 2008, 2009 as well. So we just have a lot of strength in this. It's really coming from those who are most credit worthy, and obviously people with less positive credit are having a little bit more trouble. But it's still surprising to see these numbers overall. So now we've got some trade data. I mentioned in our high frequency data that the commercial sector is doing pretty well. And you can see here, one of the ways you can measure the health of an economy is how much they're importing and consuming. And while we've been jockeying around, we've had net imports go down over the last several years and kind of troughed in April, but they've really rebounded well. I mean, there's a demand for imports. There's a consumption demand that is out there and it's tangible. Now, we're not exporting as much, and that's, for a lot of reasons. Global trade is contracting. Even though you've got a weak dollar, which ideally should help your exports, you've got some trade considerations and some trade spats, if you will, that are contributing to that. But it's positive to see import volume here at this point in the cycle. And as we're talking about domestic shipping and kind of the commercial transportation markets, you can see that this number itself is very positive, and we've kind of talked about some of that in our high frequency data. But here we are in October, year over year, we're actually positive, which is kind of hard to believe. So obviously we were well negative earlier this year. Battled back. I think the trend line is positive overall, as you'll see in the next chart, that's distributed a little differently than you might expect. Not all sectors of the shipping market are doing well. Now here's a little bit of a busy slide. You've got several things going on here. You actually, in the upper left, you have truckload fleets. And then you can see that we actually have capacity constraints here. So, what that's doing is it's sending prices higher, and that's on the right-hand side. And you can see those rates going up because capacity is lower, but you've got more demand and throughput overall, because you see that those import numbers in that prior slide are going up, and that there's consumption out there, but there's fleets are lower, and so prices are going up on the truck side. Now, when you get to intermodal, which is really more rail-bound traffic, oddly enough, we're at a very low point. So it's interesting to see that you can see the truckload market being very strong, almost too strong for its own britches, but rail traffic and intermodal price index being exceptionally low. So we'll talk about labor a little bit. I've talked a lot about it, frankly, but here's the monthly payroll employment. It's continuing to kind of level off, if you will, below where we were in February. So obviously that's something to consider. Some of these are small businesses. Some of these are medium-sized businesses that have kind of reduced their headcount, what have you. Just an overall kind of flattening out in the progress that we've seen in the labor market. Now on the right-hand side, now this is protracted joblessness. This is from Bloomberg. And what this tells you is the transition from the, I guess, duration, if you will, of unemployment, looking at it from April all the way through the end of last month. And so what you can see is that April, obviously, duration of unemployment, there was a large number of people that were unemployed, but they weren't unemployed for very long. That number, again, spiked in May, June, July. It kind of started to go down. You start to see those early kind of short-term folks kind of transition into longer-term, but at the same time, we started to recover in the labor market, so the aggregate numbers kind of went down. But what you see now in October is that we've got an increasing number of unemployed persons that have been unemployed for 27 weeks or more, and that number is going to continue to eke up. And what you hope is that we don't stall and reverse in the labor market, and then you see that orange bar begin to increase again at the same time that kind of that blue aqua bar, greenish bar, if you will, on the right continues to go up as well. I thought this was kind of interesting because it gives you a little bit of socioeconomic perspective here. So again, not all boats are floating in the same manner. You've got lowest earning industries and highest earning industries, each of which have been affected, but to varying degrees. This chart just kind of gives you some perspective that obviously low earning industries have been impacted so much more significantly in this pandemic. Continuing our thought on the household and their wherewithal, and kind of revisiting a statistic that we were talking about earlier this year. There's still a lot of folks out there that are struggling, as you can certainly imagine. Small business owners, employees that have been displaced and continue to be displaced. And you still see that there's 5.6 million people that have no confidence in their ability to pay next month's rent. And a lot of the forbearances are going to vaporize at the end of next month. So I won't even use the word interesting. It's going to be, I think, profound if we don't have some type of stimulus to help those people out, or extend some forbearances and then give some relief to landlords that are also suffering from the cash flow side. We're going to have a problem with this. I mean, you've got 8.9 that say that they have slight confidence in their ability to pay, and then even 12.9 million that say they have moderate confidence. And these aren't kind of responses that give you a lot of comfort that we're not going to have a lot of second order impacts in the residential real estate sector, especially real estate owned. You could see more bankruptcies from property owners and property and more defaults on the part of property investors. I just think that there's too much noise in these numbers here to not pay attention to it. This is not consumer confidence as it's reported by the Conference Board. This is ICS. As it says down at the bottom. It just comes to us from Daily Shot. It's a measurement of consumer sentiment, and it's kind of a relative index. And it's updated again. This is very current information, and you can see that the increased wave of coronavirus cases we've clearly seen that roll over. The confidence kind of roll over at the beginning of November, and we're currently in that downtrend for confidence at appropriately the wrong time as we head into the holiday season. I thought this was very interesting out of some Charles Schwab research, and I highlight this because the stock market globally, which is represented by that pie chart on the right, is almost half made up of manufacturing firms. Again, that's not the case necessarily in the U.S. There's a lot of service firms, but if you look at the global marketplace, all of the stock markets across the world, over half the companies that are publicly traded are manufacturing firms. But as far as the global economy is concerned, manufacturing only represents 17%. So what this tells you within a backdrop of relatively decent overall manufacturing across the world is that you're getting those stocks and maybe global stocks to respond, but you're not seeing it in the corresponding GDP numbers because manufacturing is dwarfed by the consumer. It's dwarfed by services, and we know that those are depressed all around the world. All the way from hospitality to retail concepts and whatnot. But very interesting to see the dichotomy here. This is clearly an index that shows you that optimism is high. We've seen a lot of net inflows into equities over the last week. A lot of people chasing the caboose on the train. I'm here to tell you, I think that there's probably some reasonable staying power in the market, and I think there's a platform for growth next year. However, as hopefully I've made clear in these previous slides, that there's a lot of risk factor that we need to take stock of, and things that we're going to have to navigate through the next couple of months, as we await what we think might be a second large fiscal stimulus package, more data on vaccines, and getting through some of the trials and tribulations of actually kind of deploying it. There's going to be a lot of news flow, and not all of it's just going to be peaches and roses. And then obviously we're going to have to navigate through, I think, what could wind up being a kind of a tough economic environment this holiday season, where you're not having people travel. Maybe you're getting a lot more online sales, but you're not going to have nearly as many people walk the stores as has been the case historically. But at least right now, there's a lot of investor optimism out there. This is something that I like to show from time to time to kind of remind us, this world of volatility that we live in now. If you go back, years and years and years, the aggregate changes in the index on a day-to-day basis weren't as significant because the index simply wasn't as high. But, when you're in a world where, you've got an S&P kind of, now within a very broad range, like 3,500 on the index, I mean, your aggregate moves are fairly strong, and the average moves that you see are fairly strong. But in addition to that, you've seen a lot of headline-based moves in the stock market that really don't have nearly as much to do with fundamentals as it does with investor sentiment. And what that's done in 2020 is it caused a huge spike in the number of trading days where the market has moved over 1%. I mean, even considering 2008, which was a very volatile period, and lots of magnificent moves in the market, we've clearly surpassed that here in 2020 with roughly about a month and a half to go. This is something that I wanted to show coming out of Bloomberg as well, that this whole relationship between large and small company stocks. And, at the beginning of the pandemic, I mean, there was clearly an advantage over having large company, good balance sheets, so on and so forth, over small company stocks that were typically more exposed to the economic downturn or whatnot. Well, that advantage, if you will, has narrowed, and you're seeing greater participation on the part of small caps and smaller company stocks, which is good from a market health standpoint. And kind of to wit, this is a little bit more of a concentrated view, but we've talked a lot about the FANG stocks. We've talked a lot about the stocks the handful of stocks, literally the top 5 stocks in the S&P 500 that have accounted for tremendous amount of growth relative to the other index members of the index. But you can see that, actually since the beginning of September on the far right there, you've had those big 5 stocks, those technology firms actually witness a decline, whereas you've seen a slight uptick from all of the other participants in the index. So this is kind of this leveling of the playing field that we needed to see to kind of get back to a more healthy environment, even if that means that we have muted returns from here. But you never like to see a narrow leadership of the market because that creates a tremendous amount of risk. So anyway, the takeaway here is on net, on balance, positive. So kind of continuing that thread, we have about 80% of the stocks in the S&P 500 that are trading above their 200-day moving average. That's a very healthy sign. It shows a lot of breadth, like I said. That's good. Well, what does the market typically do when you have that? You can see on the left is kind of the average returns overall. And this is looking, basically 1990 through current. And on the right, it shows you after you hit that, plus 85% of the companies that are above their 200-day moving average. And we're almost there now anyway. You can see that the market typically does outperform, both on a, I'd say more so on a 3-month return, and you get to 6 and 12-month returns, that you typically see a little bit better performance in the market in that case. And we'll end today on something that I just am consistently fascinated with. I mean, this is, again, not to wax philosophic on global warming per se, but it's just highlighting a fact I think it's just just clear that we've seen this uptrend in the incidence of natural disasters, and not just storms. Even though storms have increased, you can see, if you go back to, kind of that 2004 level, I mean, we're trending above that. And then flooding, we've seen, more flooding, just overall more incidences of that. And again, I'm not here to make here or there, on this, but I will mention it from this perspective too, that disruption to commerce as a result of natural disasters, even disruption in the whole risk assessment and the risk control industry is keenly aware of these statistics. And this is something that is obviously going to become more of an issue if this trend continues, that you're going to have shipping lanes that are going to be disrupted more often because of storms out at sea, and more issues that are going to cause flights to be delayed or rerouted, freight to be delayed. Inefficiencies are inherently going to build because as much as we know about meteorology, there's still so much more that we can learn, and still relatively incrementally more that we know than we did 20 years ago on how storms develop. So this is interesting from an analysis standpoint, but it's also going to be important from an economic one as well. With that, we will conclude the comments for today. This is Thanksgiving week, so if you're still with us, I hope you and yours have a wonderful and safe Thanksgiving. Our information here, please feel free to reach out. And we'd love to hear from you. And take care, and we will talk to you soon.